So this week we were talking about housing shortages. We were talking about labor weakening and credit stress emerging and development deals falling apart. And last but not least, Bank of Canada had their interest rate announcement. Hello, Smarties, and welcome back to another episode of Smart Real Estate with Learn, Invest, and Manage. So we've got a couple of changes that are coming through. The number one is we are actually launching a brand new website. It's called learninvestmanage.com. It goes with our ethos. What we are trying to do is create tools that are useful for investors like yourself. If you want to do quick calculations on a flip project, if you want to do quick calculations on what the return would be for a multifamily investment that you're looking at, we are creating all those tools and they will be available at learninvestmanage.com. We might actually host them at a subdomain called tools.learninvestmanage.com, but you'll be able to access them all through that main website. Our podcast is also going to be moving over there. We used to have the podcast hosted at westcliffam.com/listen. The links are all still the same. Even if you go to those old links, you will be able to access the new website from there as well. The idea is that we're trying to streamline and create the podcast as a standalone data center, a research facility, rather than being a marketing campaign or a extension of our businesses. The other format that we'll be changing is that now we will be doing weekly podcasts where we're talking about events and postings that we are making on our social medias. So if you follow us on TikTok, Instagram, Facebook, YouTube, LinkedIn, anywhere, you will know that we've been very, very active in posting different articles and talking about what's happening in the real estate market, especially for multifamily investors. And what we wanted to do is actually set up a weekly call where we do a bit of a roundup. So anybody that likes to have a longer format, you can watch this on YouTube and on audio format, wherever you get your podcast. So what we will do now is we will run through and see all the different articles that we had talked about and give you a bit of a rundown of what that means for you if you are a real estate investor. So this week we were talking about housing shortages. We were talking about labor weakening and credit stress emerging and development deals falling apart. And last but not least, Bank of Canada had their interest rate announcement. So we'll talk about that a little bit as well. One thing I would like to point out that we are in the real estate cycle entering a transition phase. So what that means is we're seeing shift in buyer and seller behavior, and we'll get more into it. So stay tuned. As you listen, think about this. Are you positioned for the next phase of the market, or are you still reacting to the last one? So we had posted about Canada housing market in a stalemate. This was a RBC report where they were talking about how home resales are down 1.3%. New listings are also down 3.9%. That's month over month. That means that not only buyers are pulling back, you also have sellers that are actually taking their properties off that market. Sales to new listing ratio was 48%, up from 46%. The other main notable point is that our inventory months of supply was at 4.99. That is a 6-year high number. So that means that inventories are rising, even though we had a pullback on the new active listings that are coming up. So home pricing index was showing that prices came down 0.6% month over month. We saw a 4.8% decline year over year, and that's 20% down from the peak in 2022. That's quite a difference. The report was a Canada-wide report. We did talk about regional weaknesses in the report. So Toronto was down 7.9% year over year. Vancouver was down 6.8% year over year. Mississauga 7.5% year over year. Hamilton and Niagara region was down 7.6% year over year. Now, there were some strength pockets as well. In Montreal, prices are up 5.9% year over year. Regina, 6.6% year over year. Saskatoon, 4.8% year over year. Basically, what we're seeing is that this is not a crash. This is low liquidity. What you're seeing is people have invested their capital into different real estate projects, and they're not able to get their capital out. You don't have buyers in the market. And when you don't have buyers in the market, you have capital that is tied to those assets for a longer period of time. What you're also seeing is sellers and buyers are pulling back simultaneously. So we see a decline in number of sales that are taking place, and we're also seeing a decline in number of new listings coming up. The listings declining could be twofold. One, prices are still dropping. We haven't hit the bottom yet. Inventories are still elevated, and sellers are thinking, hey, you know what? I'm going to take the property off the market, and I'm going to come back in a bit and see how the market is reacting. If the market is favorable, I get an offer, I will sell it. If not, then I will still keep it. I'll keep on holding on to it. This also speaks to the motivation for different sellers in the marketplace. If you have a seller that has good rent coming in, it's diversified, so you have multiple units in the property, and they're not under any pressure, which is what we see in multifamily, prices tend to hold stronger. If you have properties that are underwater, what I mean by that is rents are not covering the expenses and the owner has to keep putting money in, you will see that those properties tend to have a lot more stress and they end up in distress as well. And sellers are willing to negotiate a little bit more. So in today's market, if you're a buyer that has capital available and you're looking for opportunities, you need to be sending offers out as much as possible, because you're not going to find out the motivation of the seller unless you send them a piece of paper to really see if they're willing to work with you on those numbers. So inventories are still elevated despite fewer listings coming in. Ontario and BC are the highest pressure zones all across Canada. We are in nearly 2 years of price declines, and this is where we're going to see a psychology shift taking place. And we're seeing this happening with power of sale listings. Power of sale listings are up, I believe, 4 or 5-fold from the start of the year. And what that means is we're going to see more and more power of sale listings coming. And those owners, they don't have any emotional attachment. It's basically a financial transaction. These lenders, they have a property that is in distress. They have capital that is tied up. That capital does not make money if it's tied up in a power of sale. So these properties need to transact. They need to get that capital out so they can get that capital lent out again so they can continue making money. These lenders will transact. And when they transact, it will start setting up some benchmarks that other properties that are in the market will get measured against. We currently have one property under contract that is a power of sale. And the reason we have it under contract is because the lender was willing to work with us. They were willing to work with the price that we were recommending, because the initial price that they had was quite a bit higher. So that's a ray of sunshine for anybody that is looking to purchase a property in today's market. If you see power of sale listings, reach out to them, have conversations with them. You might be able to put them under contract and generate some decent returns. The key insight that I have: when markets stall like this, prices resets don't happen through panic. They happen through inactivity. So you're going to see a lot of properties that will not have any activity. The select few that have activity will set the bar as to what the new prices are going to be. The other article that we had talked about is labor markets are softening. Canada's unemployment rates are rising. So unemployment went for January, negative 25,000 employments. And for February, we had lost another 84,000 jobs. So unemployment rates currently sits at 6.7%. Participation rate is at 64.9%. That's the lowest outside the pandemic since 1997. For anybody that doesn't know what participation rate is, that's the total amount of population that is actually participating or looking for jobs or works a full-time job. Total hours worked was down 1.1%. So that means our productivity is suffering. Youth unemployment, that's a key figure, 14.1%. That's high. So labor force shrinkage, January plus February, was down 146,000. There is a population shift. There was growth in January and February, which is 12,500 versus 103,000 people in the same period in 2025. So you can feel this. You can see this. If you're out on the market, if you're out on the road, on the street, boots on the ground, you feel this. Rentals are sticking longer. Actually, one point that I should point out is rentals. The number of transactions in rental has surpassed the number of transactions in sales. So there are more lease transactions that are taking place on the Toronto Real Estate Board than they are sale transactions. And that means that a lot of the agents have shifted their focus into the lease market. So full-time jobs took a hit, 108,000 jobs negative. Manufacturing jobs were down year over year, 52,000. Constructions were down 12,000. Construction is understandable. With the interest rate environment and lack of pre-sales in the market, there's not a lot of developments that are going on, and construction jobs are shedding. So demand is weakening. At the same time, supply growth is slowing. This creates a very different rental dynamic as well. So for multifamily investors, this means that you're going to have slower household formations. You're going to have more roommate households. You're going to have pressures on rent growth. So if you are underwriting, if you're buying a property and you're underwriting right now, make sure you are conservative in your future rents and increase tenant sensitivity. So if you have tenants that are at a higher spectrum of the rent, if you have luxury rentals, careful. Pay attention to those rentals, because those are the tenants that you want to take care of. Go out there, say hi to them. If you haven't seen them in a while, check on them. Make sure that they are doing well. If you have tenants that are on the low end, do the same as well. Tenant retention is going to be an issue, especially when you have rent softening. Make sure you're taking care of your tenants. If you need any help on the tenant side, we do have a property management company as well that we work with. Actually, we own. So we can definitely help you out with that as well. Another item that we had talked about is consumer credits. So there's a company called GoEasy that does a lot of subprime lending. And subprime is different in what the sense that we know from 2008. These are loans that are made to borrowers that wouldn't usually qualify at your local banks. So they usually charge higher interest rates, and they lend out on properties that financing is not readily available for these. So think of your vehicles, your recreational vehicles. So GoEasy wrote off $178 million in loans, and they suffered a 57% drop in their stock price. That equates to $1 billion cap loss. And they also had a prior decline. They've been in decline since September of last year. There's a 40% decline. These guys were mostly lending to auto and power sports. Their repossession pipeline is overwhelmed right now, which means that their recovery of the collateral is really, really slow. So all of those pointed to a structural problem that you're seeing. Subprime issues usually is an early warning system. That means that these borrowers will overlap with workforce rentals or lower income tenants. And when you see credit stress showing up for subprime, real estate stress does come later. So it's an early warning system. So if you are a multifamily owner, these are the things that you should be worried about. This means that they have a higher correlation risk with the type of tenants that you carry. You expect to see more tenant turnover, and you expect to see less rental growth elasticity. Another project we talked about is a development project that's English Lane Homes that ended up in receivership. This is a 63 unit townhouse project in North York that had approval already in place and had started doing some work on their site. They had an approval for $43.2 million construction loan. And one of the conditions of that approval was that they would have $53.2 million in sales made with 20% deposits. They ended up with only 3 sales completed. And they did get $17 million advance to them to do some initial site work. That is why the lender actually took them into receivership, because they didn't want to advance any more funds to them. So what we have is a pre-sale model failure. No pre-sale means that no construction financing. Land is fully approved, but it's unusable. So this is not a zoning issue. This is a demand issue. What you're seeing is pre-sale failure where there's not enough buyers in the market. I ran the math. 63 units at 52.3 million in sales meant an average price of $830,000. Take that as 80%. So probably $1 million townhouse in North York actually failed. So we're going to have fewer ownerships units being built over the next couple of years. And then this means that this project might end up being a potential conversion to rental, and more land sales will be entering into receivership as well. On the flip side of it, you also have completed projects that are failing. We had talked about LJM in Hamilton. We also talked about 2 projects in Vancouver, Wave Development, which has the 15 and Chroma. 15 had a $26 million loan on it. Debt confirmed was $20.8 million. The value was $25.7 million. Chroma had a loan of $76.3 million. Outstanding was $79.27 million. Now, Chroma was a condo that pivoted and became a rental. Actually, both of the projects were condos initially, then pivoted and became rentals. The occupancy for Chroma was at 52% for the residential, 25% for the commercial. Expected NOI was $3.6 million, never got achieved. So these are completed projects, still failing. Lease-up risk is now critical and crucial. Condo-to-rental conversion is a mismatch. People don't realize what it takes to convert a condo to a rental property. First of all, the finishes are completely different. In a condo, you're going to see like Louis Vuitton and Fendi and this finish and that finish. Rentals don't care. Rental want more durability. If you have finishes like Fendi, those are going to be very, very costly to replace or repair. So you're better off not having those expensive finishes. You're better off having more wear-resistant finishes, stuff that will wear better, people by continued use. A lot of times condos will have smaller fridges and stove. You want to have large fridges and stoves. Condos will have in-suite laundry. You don't want in-suite laundry in rentals. You want to have central laundry. You want to have it as a revenue generation item. So when you have rentals, you want to have coin-operated laundry so you can generate money off of them. The other thing is when you have in-suite laundry, you need to have somebody going in and cleaning out the lint from those vents. That's a fire hazard. So you want to have control over that. There's other nuances that come into play when you are working with a condo versus rental conversion. What are your thoughts? We'd love to hear what your thoughts are. In terms of implication, newly built distressed assets are emerging. We're going to see below replacement cost opportunities, and we're going to see lease-up underwriting becoming very, very critical. Again, as I mentioned before, your future rents, whatever they are, make sure you do a rental survey to confirm those numbers. Don't rely on the OM offering memorandum if you're working with a broker, and the numbers that they're talking about, don't rely on them. Those numbers are usually overstated or optimistic. Another item we talked about is credit tightening beyond housing. An international airport in Newfoundland actually just got put into receivership. Stephenville International Airport, they had a $2.5 million debt, which was owed. The asset was the airport and the land around it. A preliminary interim receiver review showed that the value of the airport is slipping, and the lender called in their debt. It's a small debt. It's a large asset enforcement. What that tells you is that the lenders are expecting to see more stress in the market. And even though an airport is a very, very specialized asset, and you need specialized licenses, you need specialized knowledge to run an asset like that, the lender wasn't afraid to call in that debt. And they actually have a offer date set for May 6th on that asset, and they're expecting it to go into an auction. So bids are due, and it's a stalking horse bid. Bids are due May 6th. Lenders are acting faster, and it's an unusual asset to enter receivership. So something to be mindful of. When you do see lenders enforce on niche assets, it signals tightening credit conditions system-wide. So keep that in mind. Bank of Canada made an announcement this week. They held. So policy rate is at 2.25%. Core inflation, 1%. A 3-month annualized. Unemployment is sitting at 6.7%. And GDP forecast is at 1.8, which is Q1 annualized. So growth rate is tilted to the downside, especially given what's happening in the Middle East. There's oil shock that is expected. And with what's happening in the Middle East, we are expected to see CPI rising. The financial conditions are tightening. We're expecting higher bond yields and wider credit spreads. And this is not a rate cycle. It's a confidence cycle. So what this all means, these are the different talking points that we have talked about on all of our social media. What does this mean? We have stalled housing. We have job weakening. We have credits crackling. We have developments failing. And we have central bank that is uncertain. This is a textbook transition phase. So what to expect in this phase? We will see transactions slowing down. We'll see pricing becoming more inconsistent. We'll see distress appear in pockets. So you're going to see, as I said before, depending on the motivation of the seller and if they had lied on their application or if they didn't lie on their application, you'll see distress appearing and you'll see capital becoming selective. You're going to see buyers picking and choosing what they want to invest in and how much they're willing to pay for those assets. And you'll see opportunities coming from sellers who lose certainty. So these opportunities will form when we see sellers losing certainty. So when you see sellers that have been very certain on the value that they're expecting to get, and they will actually start to see that there's cracks being formed in their belief system and the values that they had placed on their assets. You will also see buyers that will hesitate. When buyers are hesitating, which is very common in a market like this, confidence is running low, and then pricing disconnects widen. What to watch for? So refinancing timeline. So we are going into 2026 where we'll see a big wave of refinances that are coming through from the 2021, 2022 low interest rate environment. So we will see some shocks that are going to be coming through. We're going to see lease-up failures. We're going to see, well, right now, new construction lease-ups or vacancy rate is currently at 7%. That should tell you a lot. So these are rents that new builders and condo owners were looking to achieve in order to be in the green or at least stay afloat. We're seeing those numbers failing. We're going to see some small landlords exit. So a lot of the mom and pop 1-2 condos, we're going to see those owners exiting. We're going to see development site listings. So these are properties that have either approval already in place or we're in the process of approving, or we're ready for construction but never ended up with enough pre-sales. We're going to see these development sites coming into the market, and we're going to see lender enforcements. So a lot of power of sales. And when I say a lot, our number have been historically very, very low. So this is a lot when I'm saying it's going fivefold. But during COVID, our power of sale number was 0.02. So 0.02 sixfold is like 1.2, 1.3% right now. And expect that to go to 2.5, 3%. That's still massive. It's still very healthy, but it's some people that are losing their investments, some people that are losing their primary home. It's distress in the market. It's not a light thing to take, but I think our market has to go through that. We have been on an unprecedented run for the past 20 years. And this is the first time we're actually seeing cracks being formed in the real estate. I shouldn't say first time. This is 2 years in. We're still working through it. And once we come through this, we will be better. So the market isn't breaking, but it is shifting. But this is a phase where prepared investors will gain an edge. Disciplined buyers will find opportunities, and those waiting for certainty will fall behind. Because certainty comes after opportunity, not before. So I'll leave you with this. Are you waiting for the market to feel safe? Or are you positioning yourself while it feels uncertain? I'm Addy Saeed. If you need more information or you want to connect with me, find me at addysaeed.com. Take care. We'll chat later.